Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. For those of you that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FISA compliant, specializing in super and non-super investments. I'm not licensed anymore, but I would love to get that license back one day. I left the industry as I couldn't stand the owner of the business. I've got no interest in sales. I mean, look, it's not all sales, but my passion is to help people, not to sell various managed funds or insurance products. These days, I work in tax and compliance. Now, I bet you're wondering, what does a financial advisor actually do? I see a lot of comments online, dissing financial advisors and saying that their job is not worthwhile. Anyone can do what an advisor does, etc., etc. Now, in fairness, there were some good financial advisors and some bad advisors, and there was a lot of good information out in the public domain. I personally try my best to put out useful content that will help educate people to make informed decisions without giving advice. However, just because this information is available doesn't mean that an advisor is worthless. There are a lot of aspects of financial advice that people don't appreciate and that require more than just being able to read some numbers or description on the screen. First off, what does an advisor do? Well, they do a lot. A financial advisor will look at your current investment portfolio, be it at super or outside or both, and can help you adjust that portfolio to something that might perform better or that can steer you in the right direction. Now, there was a lot of information that you can use to create your own portfolio. I've seen a bunch of things where people say you need to do a 20% split Australian, 80% international, or you need to do a 50-50. Neither of these are necessarily wrong, but at the same time, they're not necessarily right. The world is in constant fluctuations. It is beneficial to have both Australian and international equities. I don't think anyone would advocate for you to only have, hold one. However, the percentage split between, each is, what you need to make your own decisions. At this point in time, Australia makes up around 2% of the global equity market. If you want a truly global market cap allocation, you have your Australian allocation as a very small part of your portfolio. If you're very home biased, for example, and you love franking credits, you might have it as a very big portion of, very high allocation to Australian shares because you know and you understand Commonwealth Bank, for example, or you work for BHP or whatever it might be. An advisor would take a balanced approach. Generally, there is a range that they're given by the licensee, which says how much or how little to put into each asset class based on your risk profile. Yes, you heard that right. Risk profile. Everything I've seen online is generally talking about a 100% growth portfolio. This might be fine for some people, but it's generally, a hold period of 10 years plus. If you're investing for 3 to 5, 100% is probably not the best option. When it comes to asset allocation, there are a number of research analysts behind the advisor, which helps them, with their own asset allocation. And the advisor will generally make their own decision within a 15% range of that allocation. If you're working in retail or a restaurant or the Defence Force or IT, you are bound to be an expert in your field. You are unlikely to be keeping track of every market movement and making predictions for the future. This is where an advisor spends their workday doing. And most enjoy the job so much that, they will continue to do this analyzing even their own private time. Will they always make the best prediction? No, probably not. But it's bound to be better than the average Joe that's just taking a shot in the dark. Most advisors don't pick individual stocks. No one knows what Apple's going to do next year. They'll probably release a new phone. Other than that, who knows? What advisors will do is help you fine-tune your asset allocation and update it to match the current and projected market performance. I briefly mentioned risk profile, and there are a number of different risk profiles. It starts off at 0%, there's 30, 50, 70, 85, and 100% growth. Each one will have their own asset allocation based on how risk adverse you are. If you don't know how risk adverse you are, you can never really invest appropriately in line with how risky you like to invest. Being invested in a high risk profile will generally, and I emphasize generally, provide you with a greater return. What you need to consider, however, is that this is on a long-term horizon. On a 1 year, you never know which will perform better. Same for 3 years, 5 years, 7 years. Different asset classes perform better at different periods of time. Equities have done well recently. At some point in the past, cash has also done really well. And there have been periods where fixed interest was number one, also a time when property did the best. It really all depends on the macroeconomic environment, which your average Joe won't be able to discern, but a good financial advisor should, given how much time they spend looking at what's going on in the world. Each year, it will be a different asset class. And if you're not appropriately invested in line with your risk profile, you're likely not to be optimally invested or lose out on to underperformance of the benchmark. The reason most people, when investing, personally underperform the market is because they dip in and out. They're constantly buying and selling. With an advisor, they will help you to not sell. This is the key to building wealth. You don't need to be perfect with your predictions or your timing. Just don't sell. As a financial advisor, I cannot tell you the amount of clients we had that wanted to sell out of the market during COVID or when the war in Ukraine started. I can guarantee you that they have outperformed by holding than if they had sold and tried to find some re-entry point. It's the advisor's job to keep you calm and to stop you from making a rash decision to sell and make that mistake. If you are in a 0% growth risk profile, for example, you should be invested solely in cash and fixed interest. If you then do it yourself and suddenly you're 100% equities, because that is what online is preaching to you, you're much more likely to sell out and make massive losses when the market dips than if you'd stayed within your risk profile, staying as pure cash and doing it yourself. You're shooting yourself in the foot. A financial advisor doesn't just deal with your investments. They can also help with implementing different strategies and with insurances. There are a lot of different things that advisors can help you with. I'm going to mention topics I've already talked about on the channel. If you want to do a deeper dive and look into them, check some of my older videos. Stuff like debt recycling. This is turning non-deductible debt into deductible debt. There's the recontribution strategy. That's turning the taxable tax portion of your super into the tax-free, which will reduce your tax payable by beneficiaries when you pass. There's generally aid with budgeting, and sometimes they can help you sort out different government incentives, like the First Home Super Saver Scheme for buying your first home, or what you need to do to get the full government co-contribution for your non-concessional super contributions. They will help you with projections. Most people don't really know how to use Excel properly, and they wouldn't know how to create a projection chart. If you want to retire at X date, and you want to keep your current standard of living, how much money do you need? And from there, how much do I need to save? Most people live paycheck to paycheck, and they only worry about retirement when they're a few years out from, say, 60 or 67. And then they find out, I'm not actually where I want to be. The last thing I'll go into is insurance. This seems to be a big taboo topic from what I've seen discussed online. I cannot tell you how many times I've seen people say they want to cancel the default insurances within super to save that small premiums. I'm not going to say you need to keep those insurances, but you need to make an informed decision around insurances in general. I have made a video on insurances, so make sure you check that out. But you need to know what each type of insurance is and how it works. If you're 20, single, no dependents, and no debt, you probably don't need life insurance. Same if you're 60, the kids have all moved out, and you've got $2 million in net assets, not including your home. However, if you're married, you've got young kids, and you've got a ton of debt, you're probably going to need some insurance. I personally have about $1 million in life cover, and this would pay off all of our mortgage debt. It won't be enough to cover like the wage I would have earned if I was still alive, but at least it will keep my partner and family from going under. Financial advisors also deal with trauma cover, TPD, which is total and permanent disablement, as well as income protection. These are all important insurances in their own right, and they have their own places. If you never need to claim on them, you're lucky, and congratulations. However, I have seen a lot of people talk online about how they had some medical emergency or a car accident or something that if they had just kept their insurances or even got new cover through an advisor so that they were appropriately insured, they would be in a much better place financially and not struggling. But because they didn't and they canceled the insurances to save a couple of bucks a week, they're now tens of thousands of dollars in debt, and maybe they're about to lose their home. It's really sad seeing this, and it's something that could have easily been prevented with an advisor. Financial advisors generally don't charge for creating a statement of advice for insurance. So insurance companies pay a commission, It's standardized across all companies, so advisors have no conflict of interest advising you to go with one insurance company over another, and that is how they get paid. You'll find that if you were to go take out, the same insurance policy yourself, it's probably going to cost you the exact same. The insurance companies just take a lower profit and they pay the commission as a way to get clients in the door. They think of it as the cost of client acquisition. Similar to a mortgage broker. When you get a mortgage to a broker, the bank doesn't charge a high interest rate, neither do insurance companies. The benefit of using an advisor over going direct is that the advisor deals with the insurance company on your behalf when and if you need to make a claim, saving you time and hassle. They also make sure you have the right amount of cover. You're not paying for cover that you won't get paid out, and if you're uninsured, you're not left in a hole after the claim. Finally, they make sure that you get the cover that gives you the best benefits, that there's no exclusions or loadings that you're unaware of that maybe wouldn't apply if you'd use a different insurance provider. Hopefully, I've been able to give you a better understanding of the role of financial advisors and how you can make the most of them. If you have any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you guys so much for watching, and I'll see you in the next one.